Welcome to this explainer. If you've ever felt like the financial world is just this incredibly complex maze of jargon, well, you are definitely in the right place. Today, we're going to clear away all that confusion. We're focusing on one single concept that literally acts as the steering wheel for the entire global economy. By the end of this, I promise you're going to leave smarter than when you started, and you'll finally understand why the financial world actually moves the way it does.
Okay, let's take a quick look at our roadmap. We're going to cover the most important number in the economy, the time value of money, interest in everyday life, the Economic Balancing Act, and finally, the power of central banks.
All right, Section 1, the most important number.
So let's start with a really simple question. What do you think is the single most important number in the economy? If you ask around, people usually guess inflation, or maybe the unemployment rate. Some might even argue it's overall economic growth, but actually, there is one underlying metric that sits beneath all of those, just quietly influencing every single one of them.
And that is interest rates. That's right. A single change in interest rates can affect literally everything. We're talking how much you pay for a house, what you earn on your savings, whether a business decides to expand, or even whether a whole country's economy grows or shrinks. But despite being absolutely crucial, most people don't really get what interest rates actually are. So let's build that understanding from the ground up. At its absolute simplest, interest is just the cost of borrowing money and the reward for lending money. Think about what happens when someone borrows cash, right? They get immediate access to purchasing power today. And in exchange for that immediate access, they agree to return more money in the future. That extra amount? That's the interest.
Let's look at a really practical, everyday example. Let's say a friend lends you $1,000 for 1 year. At the end of that year, you agree to repay them $1,050. That additional $50 is the interest, which means, doing the math, your interest rate is 5%. At its core, that is the whole shebang. You receive money now, and you agree to repay just a little bit more later.
Moving right along to Section 2, the time value of money.
Now, why charge interest at all? It's a fair question, right? Why wouldn't lenders just give you the money for free? Well, lenders demand compensation for 3 very specific reasons. Step 1 is the time value of money. Step 2 is risk, because let's face it, there's always a chance they won't get paid back. And step 3 is inflation, which basically means money loses its purchasing power over time. Let's break that down.
Imagine I offered you a choice right now. Option 1, I hand you $1,000 today. Option 2, I give you $1,000 exactly 1 year from now. Most of us instinctively grab the money today, right? Why? Because money you have today can be used immediately. You can go spend it, you can save it, you can invest it. Money today simply has more value than that exact same amount in the future. So, because lenders are temporarily giving up access to their cash, they expect to be compensated for it.
All right, Section 3, interest in everyday life. Let's see how this actually hits our wallets.
How does this play out in the real world? Well, the most common everyday impact is a mortgage. Say you want to buy a house, so you borrow $300,000 from a bank. The bank charges interest because they're letting you use their money for decades. And here's the kicker. The higher the interest rate, the higher your monthly payment. A house can suddenly become completely out of reach financially, even if the actual price tag of the house hasn't changed a single cent. And the exact same thing applies to car loans. The car is the same, but the cost to finance it changes. And don't even get me started on credit cards, where rates are way higher. Carrying a balance there means those interest charges accumulate incredibly fast.
Let's zoom out a bit for Section 4, the Economic Balancing Act.
Here is something a lot of beginners completely miss. Interest isn't just a penalty for borrowing, it's a two-sided coin. Look at borrowers and savers. Borrowers pay interest, which means higher costs for them. But who receives it? Savers do. When you deposit money in a savings account, the bank pays you interest because they're basically using your money to fund their lending. So the crucial takeaway here is that interest is a balancing mechanism. If you're a borrower, higher rates mean higher costs. But if you're a saver, higher rates actually mean higher returns for you.
Now, let's apply this balancing act to the business world. Imagine a company wants to build a huge multi-million-dollar factory. If borrowing costs are low, it's a green light. They build, they expand, they hire workers. But if borrowing costs suddenly spike and become high, the math might not work anymore. They might have to delay the project, cancel it entirely, or just slow down hiring. When rates are low, the economy tends to expand. When rates are high, things cool off. Millions of these decisions are happening all at once, all based on this one single number.
Which brings us to the big leagues. Section 5, the power of central banks.
Most countries have a central bank that's responsible for keeping the economy stable, and their absolute favorite tool, the interest rate. But we need to clear up a massive misconception right here. Central banks do not control every single rate. They aren't in a back room setting your personal credit card rate or your car loan. In reality, they only influence short-term benchmark rates. It's kind of like dropping a stone in a pond. They shift that benchmark and the ripples spread out through the entire financial system, eventually influencing the rates at everyday banks.
So how do they actually use this tool? Well, let's say inflation is running way too hot. Prices are shooting up, people are spending like crazy. To cool things down, the central bank steps in and raises rates. This makes borrowing much more expensive, which naturally leads to lower spending. People pump the brakes, businesses become more cautious, and as demand cools off, that inflationary pressure starts to come down.
But on the flip side, what if the economy is struggling? Growth is slowing down, people aren't spending, and unemployment is creeping up. In that case, the central bank lowers rates. This creates incredibly cheap borrowing, which encourages consumers to spend and businesses to invest. It stimulates economic growth. It is, quite literally, the gas pedal and the brake pedal for the entire economy.
Before we wrap up, I really want to bust a couple of common myths. A lot of people assume low rates are always good and high rates are always bad. That's just not true. While low rates are great for stimulating growth, they can also cause dangerous asset bubbles and encourage people to take on way too much financial risk. On the other hand, high rates might slow things down, but they are absolutely essential for reducing runaway inflation. And remember, they actively reward people who save their money. Neither one is inherently good or bad. It just depends entirely on what the economy needs at that exact moment.
Okay, let's bring it all together. What are our key takeaways? First, interest rates are simply the cost of borrowing and the reward for saving. They exist to make up for the time value of money, the risk of lending, and the erosion of inflation. They act as this beautiful balancing mechanism between borrowers and savers. And finally, they are a tremendously powerful tool used by central banks to keep our economy stable.
I love this quote from our source material. Interest rates are not just a banking concept. They are one of the fundamental forces shaping modern economies. And it is so true. Once you grasp the concepts we just talked about, you finally get it. You understand why financial markets hold their breath during central bank meetings and why your own financial decisions are tied to these massive global forces.
Now, we've seen that central banks use this tool to manage the economy, but that leaves us with a pretty massive question. When prices are truly spiraling out of control, how exactly do central banks wield this incredible power to actually fight inflation and win? Well, we're going to decode that exact process in our next explainer. Thanks so much for hanging out with me today, and keep learning.